This lesson will go into the other ratios that we also use in ratio analysis. Activity ratios also help us in analyzing the operations of the business. So today we are going to do the third set of ratios. We already did the profitability and the liquidity ratios. We are going to now do the activity ratios. So the activity ratios or the turnover ratios, that is the third set of ratios that we are going to do. The profitability ratios was your gross profit margin, your net profit margin, your return on capital employed. And the liquidity ratios, we had the current ratio and the acid test or quick ratio. So now we are going to do the final one, turnover ratios. But what is turnover? So turnover is an accounting concept that calculates how quickly a business conducts its operations. So the turnover ratios that we are going to learn how to calculate, they calculate how quickly a business collects cash from its accounts receivables, and it also calculates the inventory sales. So what are some of the questions that an owner may usually want to know? How quickly does the business collect the cash from the accounts receivables? How quickly or fast the business sells its inventory? And how quickly the business would pay its accounts payables or its creditors. Now, that is very, very important for many reasons. One of them would have to do a bit with liquidity, because remember, accounts receivables are not as liquid as cash. And if you can collect your most liquid asset quickly, as fast as possible, that means that your business will be more liquid. And also the liquidity would affect the ability to pay the accounts payable. So you're also calculating, are you able, or how quickly you are paying your accounts payable. Inventory is the least liquid of your current assets. So you do want to know how fast are you selling them and therefore converting it into the most liquid asset, which is cash. So the business would want to know that, and this is why we calculate what we call activity or turnover ratios. So we're going to start with the ones that involve the accounts receivable and the accounts payable. Remember, accounts receivables, also known as trade receivables, also known as debtors. And then the accounts payable, also known as your creditors or your trade payable, which is a new term that you're seeing more often. All of them mean the same thing. So in your workbook, you would see three ratios, which would be your trade receivables to sales. Remember, trade receivables is the same as debtors and accounts receivables. So we will learn the formula for this ratio. Then we have the second one, which would be your trade payables to purchases, which would be your creditors, also known as your accounts payables over your purchases. And then the last one is a ratio. It's not in the syllabus, but we will still just bring it for your knowledge, make you aware of it, would be where you're comparing your receivables to your payables. How much do we have to pay as opposed to how much we have to collect. So you do that little comparison there in terms of that relationship. So the first ratio that we are going to look at would be your trade receivables or accounts receivables to sales. And this is the formula here. And it is expressed as the average number of days that the customer takes to pay the business amounts owed. So once again, the receivables to sales, this ratio expresses the average amount of days the business takes to receive the amounts owed by the debtors, receivables, or customers. All of these the same thing. So how long on average does it take to collect its money that is owed to them from the customers after they have purchased from the business? So after the business has sold to them on credits, they became debtors. How long does it take them to now pay that amount owed to the business? So the receivables to sales, just want to point out that the receivables to sales ratio, the formula is in the name. What are the two things they have? Receivables, sales. So it's basically your accounts receivable over your credit sales. Credit sales particularly because it's credit sales that produce debtors or receivables. It's only when the business sells to people or the customers on credit that they become receivables. So it's the accounts receivable over your credit sales multiply by 365 because we are expressing this in the average amount of days. So there are 365 days in a year. So you're going to multiply by 365 and whatever answer you get, you just add days to that. Once again, accounts receivable over credit sales multiply by 365 and whatever answer you get, days. Credit sales in particular, but if you only have a sales figure in your income statement or they only give you a sales figure, you are assuming that that is your credit sales figure, that all the sales is credit sales. So whatever sales figure they give you, if it's only one figure they give you for sales, that net sales figure, that is the figure that you're going to use in this formula. Here we have in our workbook an example, very, very simple. If the receivables are 3,600 and your credit sales is 32,000, you just divide the 3,600 by the 32,000, multiply it by the 365, and the answer you get, which is 41, it's 41 days. So in this example, the receivables take 41 days on average to pay the business the amounts that they owe. So we're just going to do a nice little example. What you see here in this example is you have two businesses, business A and business B, and you have two amounts, which would be your credit sales and your accounts receivable. So these are the relationships that you're going to look at, the relationship between your receivables and your credit sales. And we're going to find out on average which business collects its debts from the debtors faster. So that is the question that we are asking here. And in order to find the answer to that, we are going to do the receivables to sales ratio. And once again, the formula is actually in the name of the ratio. So it would be receivables over your credit sales. And then because it's being expressed in the number of days on average, that means you're going to multiply by 365 because 365 days in a year. So using this formula, you are now going to work out the receivables to sales ratio for business A and for business B. Okay, so using the formula, we have for business A, since it's receivables over credit sales, you go for business A, your receivables will be 2,700, so 20,700 over your credit sales, which is 124,400, and then you multiply by the 365, and the answer you get, well, in my case, rounded off to 2 decimal places, 60.73, and we are expressing it in the number of days. So the correct answer would be 60.73 days, or 60.7 if you're rounding it off to 1 decimal place. All right, so that is for business A. And then for business B, it's the receivables, which would be the 4,380 over the credit sales, which for business B is 66,190. and then you multiply it by the 365, and that gives you an answer of 24.15 days, or 24.1 or 24.2, depending on how you round it off. But make sure you must always have days. The days, it's not going to be correct if you don't have days, right? Because once, like previously I said, it can be 24.1 anything. You have to be very specific because this ratio is telling you the average amount of days that it takes for us to receive. So these were our answers for the receivables to sales figure. For business A, it was 60.73 days. For business B, it was 24.15 days, which means that business A takes 60.73 days on average to receive the amounts owed from the debtors, whereas business B takes a shorter amount of time, 24.15 days on average to receive the amounts owed. So business B receives money faster. So based on this ratio, you would see, in fact, business A takes a while on average, because that is almost 2 months. And whereas business B is less than a month, and they collect on average their money owed. So then we will go on to the second ratio, which would be your trade payables or your accounts payables to purchases. Once again, it's your credit purchases, because it's only when the business purchases on credit that the suppliers that we purchased from becomes the creditors or the accounts payable. So we owe them money, and this ratio is going to calculate how quickly we pay them that money that we owe them, how quickly the business pays that money owed to the suppliers. So there we have the formula. The formula is in the name once again. Payables to purchases ratio, which means it's your accounts payable or your trade payable or your creditors over credit purchases. Once again, specifically credit purchases. But if they only give you a purchases figure, that is the figure that you're going to use, assuming that all the purchases are credit purchases, right? So it's your accounts payable over your credit purchases, or whatever purchases figure they give you, multiply by the 365, and the answer you get, days. So in our example in the workbook, we have the payables was 2,400, credit purchases was 27,700, multiply by 365. Very easy, just plug in the figures in your formula and you will get answer as 32. And 32, you add days to it, which means that the business takes 32 days on average to pay the creditors or the payables the amounts that are owed. So let's go to an example. We have the same businesses, business A and business B, but we have two different items because we are looking at the relationship for the payables payment period. So the relationship is between your payables and your credit purchases. And you're going to calculate or give the answer to, on average, which business actually pays its debts faster. So you're calculating your payables to purchases, and the ratio is in the name. Payables over credit purchases multiply by 365, and you're going to calculate that for business A and business B. Right, so for business A, when you're plugging in the figures, business A, you come here and you see its payables, which would be the 17,200, over your credit purchases, which is 41,500. And then you multiply by the 365 to express it in terms of days, and you got an answer of 151.28 days, or 151.3 days, depending on how you're rounding it off. Make sure, once again, emphasis, days, very, very important. And then for business B, plugging in the figures, accounts payable, 6,122, over your credit purchases, which for business B was 33,205. Multiply that by 365 and your answer you get 67.29 days or 67.3 days, depending on how you rounded it off. Emphasis on the days. So when we did our working to compare the two businesses, you would see that business B, once again, they take a shorter time, or they pay off their debts to their creditors faster than business A. In fact, business A takes a while. They take a very long while. How many months is that? About 5 months to pay off. So on average, business A takes 151.28 days to pay its creditors, whereas business B takes 67.29 days on average to pay its creditors. The last ratio, just making you aware of it, because as I said, I'm not seeing it on the syllabus on the list of ratios, but it's also an important ratio because now you're comparing for each business the relationship between the receivables and the payables. In other words, the relationship between how much the business pays and how quickly the business pays, as opposed to how quickly the business receives or collects the money that is owed to it. Once again, the name of the ratio tells you the formula. So once you see they ask you for receivables to payables, whenever you see a colon, it is basically the first one divided by the second one. So receivables divided by payables, and that's it. You just plug in those two figures. So in our examples, the receivable was 3,600. So you put that over the 2,400 and the answer you get is 1.5. And in this case, we are not expressing it in terms of days. It's a ratio. It is the receivables to payables ratio. So whatever answer you get, in this case 1.5, you are going to put colon 1. And that means for every $1.50 owed by debtors, the business owes $1 into creditors. This is how much they are owed. So the business is owed more by the receivables than they owe the creditors. So this ratio expresses the relationship between how much credit is given to customers and how much is received from suppliers. So basically the ratio is in the name. Receivables to payables, so it's just accounts receivable over accounts payable. And whatever answer you get, you just add colon 1. So once again, receivables to payables, you just find your accounts receivable over your accounts payable, and the answer you get, add colon 1. So to do this ratio, we have the two businesses once again, but this time the information that we need and that we are given is the accounts receivable and the accounts payable. And you're just going to compare how much credit is given compared to how much credit is received. We're going to calculate the receivables to payables ratio. And since, as I said, this is not in the syllabus, we're not going to spend too much time on it. And it's a very easy ratio. You just plug in the receivables over the payable for each business. And what we got for business A, the receivable 20,700 over the payable 17,200. And that gave the answer of 1.20. Add your colon 1. And that means that more credit is given than received. And for business B, you take your receivables, which would be 4,380, over your payable, which would be 6,120. And the answer you get is 0.71, and you add the colon 1. And that is the interpretation. For every dollar owed to creditors, business A is owed 120 by debtors, and for every $1 owed to creditors, business B is owed 71 cents. So these are your three ratios. Very easy, but as I said, we don't see this last one in the syllabus, so our focus is going to be on these two. And the formulas are in the name of the ratio. So trade receivables to sales, if they ask you for this, you just know it's receivables over credit sales, and because it's being expressed in days, it will be multiplied by 365, and whatever answer you get, you just add days. Trade payables to purchases, it's in the name, so it will be your payables over your credit purchases, or whatever purchases figure they give you, multiply by 365 because we're expressing it in days. Whatever answer, just add days to it and you get the full marks. So we're going to go to our last activity ratio. In fact, this here is your last ratio, and it's called rate of inventory turnover, or simply the inventory turnover. Right, so the rate of stock turnover is the relationship between cost of sales or cost of goods sold, which is the old name for it, over average inventory. The next one, which we are not going to go into now, we are going to focus on this one, but it's very easy. Once you know this ratio, the other ratio is just a kind of flipping over. But let us just concentrate on this one here. And the two things, cost of goods sold or cost of sales, which you get in your income statement. And then what you're seeing here, average inventory. Average inventory is something we have to work out. So in order to work out our rate of stock turnover, the first thing you're going to have to work out is your average stock or your average inventory. And very simply, your average stock is basically your opening stock or opening inventory plus your closing inventory divided by 2. And I don't know if you remember, with averages, it is basically you divide by 2 because it's 2 items. And what are the 2 items? Opening inventory, closing inventory. Both of these figures you should get in your income statement. Remember, when you're calculating cost of sales, you start with your opening inventory, that figure, and then you add purchases and you less closing inventory. So that is closing inventory here. You will also see your closing inventory in your balance sheet, but if you're going to one area, the income statement, you will get both figures. So your opening inventory plus your closing inventory divided by 2, and that will give you your average stock. So just to make it clearer, we would use an example. Here they gave you your opening inventory, 2,430, and your closing inventory, 2,170. And to work out your average inventory, if you remember, what is the formula? Your opening inventory plus your closing inventory divided by 2. Simple. Here are the figures. Opening inventory plus closing inventory divided by 2. And that will give you, this plus this gives you 4,600 divided by 2 gives you an average inventory of 2,300. As simple as that. So now that you have worked out your average inventory, what is left for you to do is to just plug it into this very, very, very simple formula. So this rate of inventory stock turnover, it expresses how fast inventory is sold or turned over. Let's just keep it simple. How fast is the inventory sold? And this one is expressed in the number of times per year. That is what per annum is. The number of times per year that inventory is sold. So once again, what is the formula? Cost of sales over average inventory, and the answer you get, you add times to it, and that will tell you how many times per year that inventory is sold. To make it more clear, we go to an example, and in this case we have opening inventory figure, closing inventory figure, and we have our cost of sales, also known as our cost of goods sold. And what are we going to calculate? We're going to calculate the rate of stock turnover. Now, if you remember, the formula for the rate of stock turnover was your cost of sales over your average inventory. We were not given our average inventory. We had to work it out, and we had worked it out previously because it's the same figures that we're using. So the opening inventory plus your closing inventory divided by 2 gave us an average inventory of 2,300. So as we worked that out, you see I put the answer there for you. So your average inventory is 2,300. Now we can work out our rate of inventory turnover in terms of times, and that is your cost of sales, which they gave you. If they didn't give it to you like this, you would find it in your income statement. So here it is here, cost of sales 19,100 over the average inventory that we had worked out as 2,300. The answer you got, 8.3, and this is expressed in terms of times. So you get your answer, you write down your answer, 8.3, and then make sure and you add times to that, please. So this is telling you on average how many times inventory is sold per year, and in this question, 8.3 times it is sold. Remember, we talked about another way of expressing it. So the ratio or the rate of inventory turnover can also be expressed in terms of months. So the one that we worked out just now was in terms of time, but you can also work it out in terms of the amount of months. So therefore, if we're expressing it in terms of the number of months per year that the stock is sold, then the formula would be average inventory over cost of sales multiplied by 12. 12 because there are 12 months in 1 year. So because it's months that we're expressing it in, it will be 12. If it were days, it will be 365, like we did for the creditors and the debtors ratios. But this is in months, so we're using 12. Just want to show you how simple it is. This is the main ratio that you learn off. Very, very easy. The main ratio that they have in your syllabus, your rate of inventory turnover, is this formula, which is your cost of sales over your average inventory. And that answer is expressed in terms of times. So you put the answer and then you put times. If they ask you to express it in terms of months, you would flip this formula over and put your average inventory on top, divide it by your cost of sales, and then multiply it by 12. And whatever answer you get, that one will be months. So it's the same information, but because they ask in this case to express it in terms of months, the formula would be the average inventory, which we had worked out as 2,300, over your cost of sales, which is 19,100, and then multiply by 12. And that gave an answer of 1.45, and you add months. So what it means is that it takes about 1.45 months per year to sell the inventory, which is, I guess, not so bad. So there we have our 3 ratios. It's really one ratio, which is your rate of inventory turnover. However, in your formula, whether you're expressing it in terms of times or months, in your formula, the two things or the two items that you need to know information would be your cost of sales and your average inventory. Your cost of sales, you get that in your income statement. Your average inventory, you have to work that out. So the first step, if they ask you for the rate of inventory turnover, it doesn't matter which one they're asking for. Once they ask you for the turnover, inventory turnover, first thing you have to do is work out your average inventory. And that will be your opening inventory plus your closing inventory over 2. And that will give you your monetary amount for your average. And then you would plug it into your figures, into your formula. So rate of inventory turnover, the main one that is given in your syllabus, is a very easy cost of sales over average inventory. So just memorize that. Cost of sales over average inventory. And whatever answer you get, that is times. So if your answer is 4, it will be 4 times. If your answer is 100, it will be 100 times. If, however, they ask you for months, all you do is you take the formula that you have memorized and flip it. And then add, multiply by 12. So if they ask for months, you flip this over so that average inventory goes on top, divided by cost of sales, and then you multiply by 12 because they're asking for you to express it in months, and there are 12 months in a year. So the answer you get. So if your answer is 4, then it will be 4 months. If it's 100, it will be 100 months. Okay, whatever your answer is, you add months. But this is your main ratio to remember. And remember, you always have to start by calculating your average inventory. So basically now we just have, to reinforce these ideas, you would just have an assessment or assignment to do where you will have to work out. We have 2 businesses, business A and business B. And the information given for both businesses would be opening inventory, closing inventory, and your cost of sales. And they're asking you for the rate of inventory turnover, both in times and in months. So you have to work out the turnover ratio expressed in times and expressed in months. This is a way that you can put it. So here's your question on top here. And for each business, you have 3 ratios that you're going to have to work out, because to work out your rate of inventory turnover for both of them, you still need to work out your average inventory first. So you can write it, work out your average inventory, put your formula in words, and then put your calculations. Then you will go now to your rate of inventory turnover in terms of times, expressed in terms of times. That's the main ratio, the easier ratio. Put your formula, put your working, put the answer, times. And then you will go to your rate of inventory turnover in months. Flip the formula, so you have your formula in words, multiply by 12 because of months. And then you have your working in terms of figures, and your answer, months. So you're going to do that for business A, and then you're going to come and you're going to do that for business B. Same thing, average inventory, work it out, rate of inventory turnover in times, and then rate of inventory turnover in terms of months. So that's your assignment, and you have about 15 minutes, and then we come back with the answers. Okay, so now we have the solution for business A, and we will look first. The first thing you would have had to do is to calculate your average inventory, which is your opening inventory plus your closing inventory divided by 2. Here you were your figures on top here. 12,900 plus 14,000 divided by 2, and that gave us an answer of 13,450. Now we could work out our rate of inventory turnover in terms of times. Very simple formula. It's your cost of sales, which is given here as 32,800 over the average inventory that you would have calculated above. So over the 13,450, and the answer you got would be 2.44 or 2.4 depending on how many decimal places you rounded it off to, and make sure that you have times. So the answer for business A, the rate of inventory turnover was 2.4 times. If, however, they ask for it to be expressed in terms of months, you would have, you flip the ratio from above, you flip the formula from above, and you would have average inventory over cost of sales multiplied by 12. And the answer we got was 4.92 or 4.9, and you have months. Once again, it was the average inventory which we worked out on top here over the 32,800 which is given, and you're multiplying by 12 because in this case we're expressing it in terms of months, and so we got 4.9 or 4.92 months. And this would be your 3 answers for your business A. Just freeze it a little bit there so that you can see 13,450 for the average inventory plugged into your formulas, 2.4 times and 4.9 months. Then for business B, the average inventory in this case, your opening inventory of 9,780 plus 11,500 closing inventory divided by 2, and that gave us an average inventory of 10,640. Rate of inventory turnover, cost of sales, which is given as 29,830 over average inventory, which we worked out as 10,640. And that gave us an answer of 2.8, and you must have times. So the inventory turnover was 2.8 times. But we also had to work out if it's expressed in terms of months. So flip the formula from cost of sales over average inventory to average inventory over cost of sales. Multiply by 12. So your average inventory was worked out as 10,640 over your cost of sales of 29,830, multiply by 12, and the answer we got 4.28 or 4.3 months. So there are your answers for business B. 10,640 for average inventory, 2.8 times, and 4.28 months. So now you can see it where we can compare in terms of business A and business B. Now, because the figures are so close, how do you know which one is doing better in terms of how quickly they're selling their stock? So to make it easier in terms of comparison, since the both businesses, the figures are so close, I decided to round it off just a little bit more. And you can see it's very clearly there that business B sells more times, which means that they sell their stock faster than business A. In terms of how long it takes you to sell, you would be looking for the smaller figure because you want to take less time to sell it. So in this case, you would look for the smaller figure, which would mean that business B is selling faster because it's taking less time to get rid of its stock or to sell its stock. So let's look at the figures again. So for in terms of times, you would be looking at to see which one is selling faster, you're looking at the larger figure. So in this case, it's 2.8. Business B is selling 2.8 times, whereas business A is selling less times. So business B is selling faster. And then in terms of months, you're looking for how the smaller figure. So this is the smaller figure in terms of 4.28, meaning that they're taking less time to sell their stock. Business A is taking a longer time to sell their stock. So in both these figures show that business B is selling their stock or getting rid of their stock faster. So they're doing better in terms of their activity, in terms of the selling the stock. So in summary, these are our activity ratios. It's really 3 ratios, but you need to know how to work out average inventory in order to work out your rate of inventory turnover. This can be expressed in 2 ways. Times, which is your main way, so learn this one. But if they happen to ask you it in terms of months, just flip the formula and multiply by 12. And then you have your receivables to sales, which is in the name, receivables over credit sales. And since it's expressed in days, multiply by 365. And then your trade payables to purchases, in the name, payables over your credit purchases. And because it's expressed in days, multiply by 365. So this is what you have to learn in terms of your activity ratios. And that would conclude everything that you have to learn in terms of the formulas. So you have your profitability ratios, which the 3 main ratios would be your gross profit margin, your net profit margin, and your return on capital employed. Then you had your liquidity ratios, which were just the 2 ratios, which were your current ratio and your quick ratio or your acid test ratio. And now you have your activity ratios, which would be your return on inventory turnover, where you need to know how to work out average inventory, and your receivables to sales, and your trade payables to purchases. So these are all the formulas that you need to learn. Just want to emphasize, you are not going to get this handed to you in the exam in a formula sheet. So you need to know this by memory and be able to apply it and work. But all the ratios are extremely easy. In fact, they kind of repeats of each other. Like the profitability, it's gross profit to net sales by 100, and net profit is net profit to net sales by 100. So you just need to learn it and practice it, which you're going to get to do once you do my assignments. Which brings us to the assignment, which I would post for you guys, and you will do that and you will give it up. That's the end of this lesson.